Okay, we're going to do Mr. Cat and multi-choice questions on study unit 7, study unit 7. So let's have a look. Mr. Cat is the sole owner of a trading enterprise selling pet supplies. His turnover exceeds 1 million rand. Therefore, he has to be a VAT vendor, and we are registered at 14% VAT. Okay, Mr. Cat works on a gross profit percentage of cost plus 80%. Although most of his sales are for cash, he does have some larger clients who buy on credit. Mr. Cat offers all his regular clients settlement terms of 5, 10 and N30. Now the transactions. Purchase inventory on credit for 29,640, inclusive of VAT from Doggy Wholesalers. The settlement terms offered by Doggy Wholesalers were 8, 15 and N30. Required. A. Prepare the journal entries assuming a periodic inventory system. It is recorded assuming that discounts will be taken and that the account is paid after the discount period. Okay, periodic inventory system. Therefore, we're not going to debit inventory. We're going to debit purchases. We're going to assume initially that you will make use of the settlement discount, which then eventually pan out not to be the case. Okay, so what is the first step? The first step is determine the invoice value. Invoice value 29,640. Second step, take out the VAT. What is the VAT exclusive amount? 26,000. Break it down into the two legs, the one leg being 92%, 23,920. Periodic system, we're going to debit purchases with the 23,920. The 8% being the settlement discount, so allowance for settlement discount, 2080. Included in the 26,000, so 26 less 29,640 will actually represent the VAT that we can claim, 3,640, and the full invoice value will go to the creditor's account, 29,640. Now we're going to settle the bill, and we are settling the bill too late to make use of the settlement discount. So creditors needs to be removed out of our book, so we're going to debit creditors with a full amount of 29,640. We also have to pay the creditors the full amount of 29,640 because we couldn't make use of the settlement discount. We though have to remove this settlement discount out of our books, the allowance account, so we're going to credit the allowance account, and we have to pump up the value of purchases to the full VAT exclusive amount, 26,000 of the purchase. So therefore that 2080 is going to be debited against the purchases. The second transaction is here. We have to prepare the journal entries assuming a perpetual inventory system. It is recorded assuming that discounts will not be taken, and then we settle the account in time. So if we go back, now we're going to debit inventory with a VAT exclusive price of 26,000. There's no expectation of a settlement discount utilization, so we're not going to create the allowance for settlement discount. VAT input will be debited with a VAT, the difference between those two, 3,640, and creditors is going to be credited with a full invoice price once more. When we're going to settle the bill, we're only going to pay 92% of the value of the invoice, but we have to clear out creditors completely. So we're going to debit the creditors with a 29,640. We're going to credit bank with 92% of the outstanding amount, which is 27,269. The difference between that one and that one is the VAT inclusive discount that we're going to receive. We know that we have to take the VAT out and take the VAT to the VAT output account, and then the difference of 2080 will be credited against inventory. At what value will inventory then be shown? At the VAT exclusive value, actually the 92% of the VAT exclusive value. If I'm going to take the 26 less the 2080. Okay, the multi-choice questions. Answer the following questions by writing the correct letter next to the number of the answer sheet. Ignore that. An entity sells stock at 10% profit on the selling price. So 90 plus 10 equals 100. Opening inventory amounts to 10,000. 104,500 is spent on the purchases before trade discount of 10% is considered. Returns of 950 Rand after the trade discount were made to the suppliers. If the owner withdraws stock with a sales price of R2,000 for own use and the closing inventory according to the stock count is 12,000, what is the cost of sales for the year? Now, before you're going to look at the answer, please try to do this thing on your own. Just pause the video and try to work out what is the cost of sales. Good. Now, I hope you've done that. Let's continue now to the answer. We have an opening inventory of 10,000 Rand. We're going to have purchases of 104,500 times 90%. 104,050, and then there was returns of 950 Rand after the trade discount has already been taken into account. So minus 950 Rand will give us inventory available for sale of 103,100 Rand. Our physical stock count was 12,000 Rand. So what does that mean? That means at year end, when we counted the stock and we placed a value on that stock, it only came to 12,000 Rand. If the owner took some of the stock somewhere along the line for himself, when we counted the 12,000, that stock would not have been included in the 12,000 in any event. So that 12,000 will be our closing inventory. So that means that our cost of sales equals 91,100. The 12,000 will be after the drawings has been taken into account. Now, if you're going to do a journal entry for the drawings, now that is somewhere before the stock count took place, we would have debited drawings with a sum total of the cost price of inventory taken. What was the cost price of inventory taken? Selling price was 2,000. There's our little cost formula. So 90% of 2,000 gives us 1,800. So we would have credited our inventory with 1,800. That output would have been 14% of the 1,800. So the sum total of the two, 2,052, would have been the amount that we would have taken to drawings. But this is not being asked. An entity sells stock by adding 25% profit to the cost price. What is the gross profit percentage on the selling price? 25 to the cost price. So if we're going to write down our little profit formula, it's 100 plus 25 equals 125. What is the gross profit percentage now on the selling price? So 25 divided by 125, which gives us 20%. An entity manufactures a product for a client. The following costs were incurred: direct material, direct labor, overheads, customs duty on direct material, freight cost on goods delivered to the client. The production cost, direct material, yes. Direct labor, yes. Overheads, yes. Customs duty on direct material, yes. Freight cost on goods delivered, so it's a selling cost. And the selling cost does definitely not form part of the cost price of an item. So if you look at the answer, it's a 2,000 plus a 3,000 plus a 1,000 plus 500 equals 6,500. B, 6,500. An entity uses the weighted average valuation method with the periodic stock system. At the beginning of the month, there is stock items of 100 items at an average price of 10 Rand per unit on hand. During the month, purchases of 50 items at 8 Rand each are made, and later also 20 items at 9 Rand per item. At the end of the month, 110 items are sold. What is the cost of the sale for this month if the cost per unit is rounded off to 2 decimals? So, weighted average, what do we want to calculate? The number of units available to sell, the total cost of those items that we had available to sell to get an average weighted price per unit multiplied by the 110 items sold, and that will give us our cost of sales. So 100 times 10, 1,000, plus the 50 at 8, 400, plus the other purchases, 20 at 9 Rand, 180 Rand. We had available to sell 170 items at a total cost of 1,580. What is the average cost per weighted average cost per item? 1,580 divided by 170 Rand, which gives us 929. How many items were sold? 110 items were sold. What is the weighted average cost? 9 Rand 29 per item. So in total, what was the total cost of sales? 102,190, and that is C.